Dear students, welcome to our final presentation for our Introduction to Stocks chapter. And in this final presentation, we'll take a look at some types of common stocks. Very broad categories. There are others. And what we're going to find is some stocks don't fit in any category, or some fit in 2 or 3 categories. So it's a little bit fuzzy. We'll also take a look at market capitalization, very important number, and finish with some a look at some of the different stock investing strategies. So you ready? Okay, let's get started. We're on slide 76. The most venerable, traditionally well-respected companies are called blue chip stocks. And the name actually comes from gambling, believe it or not, because over 150 years ago, only gentlemen owned stock. The hoi polloi. The general public didn't own stock, and certainly women didn't own stock. Gentlemen owned stock. And gentlemen gambled. It's what a gentleman did. And at the gambling table, the blue chips were the most expensive chips, the most valuable chips, and so that spilled over into the stock world. These are financially strong, high-quality companies with long and stable records of earnings and dividends. You'll sometimes hear people call them value stocks, but be careful. We'll come back to this value term in a bit. They attract conservative investors. Now, we're not talking politics, folks. We're talking about people who want to invest in stocks, but don't want to lose a whole lot of money. So let's take a look at some examples. General Electric, yeah, sure, they were the first they're the only stock that's still in the Dow Jones Industrial Average since 1896. And then General Motors, well, for many years, General Motors was the largest company by revenue, and a venerable, I like that word, venerable, blue chip company, but then they went through bankruptcy in 2008 and 2009, and now the new General Motors is a different company. Yeah, very interesting. And now they sell more cars in China than they do in the United States. Or maybe it's more Buicks. I think they sell more Buicks. They might not sell more Chevys. They sell more Buicks in China than they sell in the United States. Yeah, and funny, in China, Buick is like the Mercedes-Benz and Lexus. But Mercedes-Benz and BMW are trying to change that. So you want stalwarts, as Peter Lynch calls them, stalwarts, buy a blue chip company. Income stocks are stocks with long and sustained records of paying higher than average dividends. Again, sometimes people refer to these as value stocks. They are normally slow growth companies in mature industries. And the poster child for an income stock is a utility. Right, are utilities going anywhere? No, people are not going to all of a sudden decide to take cold showers in the dark. And so utilities are very good examples of income stocks. Now, banks used to be, before they started the financial innovation of the 80s, 90s, and then into the early 2000s, and it all blew up in their face, and the taxpayers got stuck with the bill. But thankfully, banks are becoming boring again. So banks are becoming good income stocks again. That's what we want. We want banks to be boring. And when you grow up, you want to be a bank. Why? Because how do you know a bank is making money? Their doors are open. Indeed, yes. Providing they're not stupid, and sometimes there is a lot of stupidity in the industry. But they're getting smart back. They're becoming smart again, thankfully. So the next category on slide 77 are the growth stocks. Here are the stars. Here are the stocks that are in the news, on the cover of Vanity Unfair and Gentleman's Quarterly in Vogue. Yeah, they have the beautiful teeth and the $200 haircut and the perfect abs. Yeah. People say they want abs of steel. I'm just happy to have abs of porridge. I'm working on those. These are the stocks that experience high rates of growth in operations and earnings. The growth rate is often 15, 20% or higher. And that doesn't sound like much, but if you were growing at 20% in 3 years, you'd be twice the size of what you are now. And they are often associated with high price to earnings ratio. Remember the PE we discussed in the previous session? Price to earnings? Right. Investors are willing to pay a much higher price for the earnings because they believe the earnings are going to grow. Often growth stocks have no dividends at all or a very small token amount. Why? Because most of the profits are reinvested into the company. They need the cash to grow. The stock price should go up as the company grows, but what are we going to get? Right. Volatility, which means it's going to be a bumpy ride. Now let's take a look at some examples. Intel, Microsoft. No. Wait a minute. Are Intel, Microsoft, and HP still growth stocks? No, that was 20 years ago when the internet was still in its infancy and everybody was going out and buying a PC. Right, these companies, well, Intel and Microsoft, have become very mature industries. HP, it's still trying to find its way. Because they make most of their money off of printers, and that industry is kind of going down. They make not the printers, they make money off the ink. They give you the printer and sell you the ink. Who are the growth stocks now? Right, the social media companies and alternative fuels and exactly what else? Indeed, the companies that are growing now are the companies that are going biotechnology. Indeed, yes, these are the growth stocks, but right, they're going to be riskier than certainly blue chip and income stocks. Now, let's take a look at slide 78, because here's a bit of a problem that you're going to encounter as you make your way through the investment world. Growth versus value. The investment world loves to use the terms growth and value. But the meanings of the terms are not exact. It depends on who you're talking to. Typically, investors often use the term growth to designate a high price to earnings stock, while they use value to denote a low price to earnings stock. Right? Because as we saw in the previous presentation, a high PE means investors are very optimistic about the future of the company. This is a very simplistic description, but that's in general. There are subtleties that are involved that we'll learn about later. And a low PE stock means that investors are really not too excited about the growth prospects, the prospects for this company. But the problem with using value to denote a low PE stock is because a high PE stock might be a great value, and a low PE stock might not be a good value. You see, when I use the word value, this is me personally, I mean I'm looking for something that is attractive. That's something there's something that can be coaxed out of this company. And so it may have a high PE, but it might be a great value. It may have a low PE. It might not be a good value. And here's a great example that I want you to think about here. In January of 2005, Google was selling for around $200. Now, they had gone public in August of 2004 at 85, so they had more than doubled their price. It had a sky-high PE. I think it was in the 60s, close to 70. The old GM, the old General Motors, was selling for $34 with a very low PE. I think it was 6. And paying a very healthy dividend. You see, So what does that mean? That means that if you were just looking at the terms growth and value, you'd say, yes, Google was growth and GM was value. But what happened? Yes, Google now sells for, I think it's more than $1,600 split adjusted with a much lower PE. And the old GM stock, which was renamed Motors Liquidation, if you can believe that. First it was called Liquidation Motors, and they changed it to Motors Liquidation. I'm not sure why they did that. It last sold for 4 cents in March of 2011 and is now worthless. So exactly, which one was the better value? In my book, the Google stock was the better value, even though it had a very high PE, whereas the GM stock had a very low PE, but I didn't think it was a good value. In fact, I kept saying to myself, short it. They're going under. Short it. Going under. I've never shorted a stock. I don't think I ever will. Peter Lynch says never short a stock. When we spoke very briefly about that. That means you think the company is going to fall. The price is going to fall. Well, I thought it was going to go through bankruptcy. It turned out I was right, but shorting a stock means you're hoping that the price will go down, and I don't want any company to fail. I'm not happy, except for Microsoft. That would be fun. I'd like to see Microsoft. But no. You want companies to do well, and you want their employees to do well, and their investors and their customers to do well. At least I do. And so I didn't. I would have made some serious change because it eventually became worthless. But make sure you understand that you're going to hear people use the term value, and they mean a low PE stock, and that's not necessarily a good value. Right. Slide 79. Now, this category is sort of a subset of the growth stock. It's called speculative. Yeah, we've mentioned this term, haven't we? These are companies with a very high degree of risk. They're typically losing money, or they have very low earnings relative to their valuation. They offer the possibility of substantial capital gains, and more likely, substantial capital losses. And these are the companies, you know what companies we're talking about, the biotech, internet, alternative fuels, companies that they could become huge, or they could just disappear, and a lot of them do. Anyone want to buy some Tesla stock? You know, folks, Tesla has the possibility of being the first car company in over 100 years to actually survive. Or it could become a flaming, falling star. I'm rooting for them, folks. I hope they do very, very well, but I ain't buying their stock. Before you do buy a company like Tesla or another company that promises the world and may deliver, take a look at the history of what's it called? GoPro. Here was a company that a few years ago was the darling of the world, and they could do no wrong. And now they can do no right. And go online, choose one of the internet, or go to the library. You've heard of the library, right? And take a look at their chart and the history of their price, and you'll see that, yep, it was a meteoric rise and then a meteoric fall. And we take this opportunity to yet again remind you of Mr. Benjamin Graham, Warren Buffett's teacher, admonition about speculation. An investment operation is one which, upon thorough analysis, promises safety of principal and a satisfactory return. Operations not meeting these requirements are speculative. That doesn't mean you shouldn't buy them, folks. I'm not saying you shouldn't buy them, but you need to have your eyes wide open and understand that you have the possibility of losing everything. You have the possibility of buying it for $11.88 and selling it for 30 cents. I did that. It was a biotechnology company based here in San Diego, and it was awesome. The technology was awesome, and it looked like it was going to be a winner. And through no fault of their own, folks, it wasn't the technology. It wasn't what It was something had to do with the testing that they did, the phase 3 testing, a statistical aberration. And the FDA said, you got to start all over again. And they went broke. And the stock just collapsed. Right. But it could have been a big winner for yours truly and those people who invested in, I can't even remember the name. Yeah, that's how painful. It wasn't that pain. I didn't lose that much, but still, that's what you when you walk into a stock like that, you know that you have the possibility of losing everything. And so we're going to learn how to identify those companies. Yes. Slide number 80. Cyclical stocks. Huh? Are they round? No. Cyclical stocks are companies whose earnings and overall market performance are closely linked to the general state of the economy. They follow the business cycle. As the business cycle goes up, as the economy grows and people get more jobs and get raises, they do well. And then when the economy falters, goes into recession, they get hammered. The poster child for this type of company are automobiles. Yes, the poster children, I should say. The poster children are the car companies. Why? Because when the economy's doing well and people are getting jobs and incomes are rising, what do? They go out and buy a new car. What's wrong with the old car? Doesn't matter. I want a new car. I like that new car smell. Yeah, when the economy falters, yeah, right. Old Bessie's doing just fine. Thank you very much. She's going to keep us there, going back and forth to work for a few more years. Other companies that are cyclical are companies that make stuff, materials, chemicals, timber, steel. Right, because exactly. The economy grows, we need more stuff, right? So now, many of the computer companies that used to be growth stocks, like Intel, are now cyclical because everybody's got to have a chip. Everything has to be made has a chip in it now. And indeed, so they've become cyclical. Defensive stocks are the opposite of cyclical. These are stocks that tend to hold their own and sometimes even do well when we fall into recession, when the economy starts to falter. Why? Because these are companies that make things that everybody buys every day, no matter what. They remain stable during declines in the market, and they're often, but not always, associated with income stocks. So what are examples? Food companies, consumer products companies, Kellogg's, Procter & Gamble. Right. Do you eat more Cheerios and cornflakes because the economy is doing better? Do you eat less food because no, you still have to eat. Now maybe, you buy the cheaper version, Procter & Gamble, instead of buying the Charmin, you buy the cheaper toilet paper, but still you got to have toilet paper. And also drug companies fall into this category, although they're a little strange because they're also growth and speculation, but drug companies that are huge and have already have their drugs out there, they tend to be defensive because you got to take your insulin, right? No matter what, you're not going to take more insulin because the economy's doing well, and you're not going to take less insulin. You're going to take your insulin. So those tend to be defensive, although some of them are falling into other categories. So you understand the difference between cyclical and defensive? Why would defensive stocks do well when the economy falters? Well, because the speculators, the traders, will run away from the cyclicals and the growth stocks and run into the defensive stocks. So they have a tendency to do well when everybody else is falling apart. But of course, when the economy is doing really well, the defensive stocks are sort of sitting in the corner by themselves, eating oatmeal. Slide 81. Okay, a few more. Turnaround stocks. Turnarounds. Well, I call these goners typically because that's exactly what they often wind up. They wind up being goners. These are companies that have fallen on hard times. And what you have to ask yourself is there potential for a rebound? Many of you weren't alive, but in the early 80s, Chrysler almost disappeared. They had a near-death experience. But they rebounded with the help from the government. They paid back every last dime of the loans they took. But people yelled and screamed then that the government should not be holding them up. And if you were brave enough to buy their stock when it went from 47 down to 3, you did well, because 3 or 4 years later it was back up to 40. All right. And the same thing is true with Chrysler, Ford, and GM in 2008 and 9. You had to decide, are they going away? And there were a lot of people who wanted them to go away. I don't think they realized just how damaging that would have been to our economy, but they wanted them to go away. They didn't want them to accept any government bailout. Well, they didn't really get a bailout. They got loans, and they paid them all back. And it looks like Ford and GM have turned around. Now, Chrysler, I don't know. They've allied themselves with Fiat. And my grandparents were all offered a boat from Italy, folks. But I'll tell you, those things do not. Well, they're better than they used to be, but still, their reliability is not good. So we'll see what happens with them. But it looks like Ford and GM are back. Yeah. So, are you ready to invest in turnarounds? Yeah. Can you say speculation? Well, you don't know. You got to know the company really, really well. Asset plays. An asset play is a company that's sitting on an asset that could be sold or spun off. And one of the great examples I tell people is JCPenney's. JCPenney's is, you think of them as a department store, and that's what they are. But they also own other assets, and one of them is an insurance company. It's very profitable. I think it's called Touchstone or some stupid name. But they sell the really horrible insurance to people who get a baby, and they try to sell them life insurance for the baby, which is ridiculous. But hey, if you want to buy it, it's your money. Take Business 121, Chapter 10, when we talk about life insurance. And JCPenney's could sell that. Another excellent example is Pepsi. Pepsi? Yeah, they own Frito-Lay. Indeed. So there's the asset that they're sitting on that people have to dig deep to find. Yeah. Now, how about penny stocks? Well, I get a lot of students asking me, what about penny stocks? Can I make a lot of money in penny stocks? Yeah, if you're one of the illegal scammers who are selling these things. But if you're buying them and trying to sell them back to the scammers, all I can say is good luck. Don't do it. There are examples on the website. They're in Canvas. They'll be in Canvas. In the face-to-face class, we'd take a look at them now. They're not real companies, folks. They're just scams. And there are thousands of them. There are literally thousands of them out there. They're just somebody's garage in Idaho or Iowa or one of those places that starts with the letter I. And they're selling stuff that doesn't exist, and they're getting now. I've noticed a lot of them are getting into the marijuana business. They're really not getting it. They're just telling people that so that they'll buy their shares. And what these people do is the people who hawk these things, who sell these things, is they do a technique called pump and dump. They pump up the price by making buzz, making noises. Now it's all internet related. And they send you emails and tell you how wonderful this stock is going to be in the next 10 days. And then when you start buying it, they say, "Oh, we got a sucker, we got," and they start raising the price, and you think, "Oh, my goodness, wow!" And then they raise the price a little bit more, and you buy more shares. And you tell your buddies, and they all buy shares. And then when they get enough money, they've made enough money, they just disappear. And now you try to sell it, and there's nobody else buying unless there's another sucker comes along. And I've had students say, "Well, can I play that game too?" I said, "Well, good luck. Do you really want to go up against these people? They're sharks. Maybe you saw the Wolf of Wall Street. That's basically what they're doing, is pumping and dumping." There's an old saying: if you don't know who the patsy is, if you don't know who the fool is at the poker table, it's probably you. So please stay away from penny stocks. Okay? All right. Enough said. And by the way, these are on the OTC bulletin boards and the pink sheets. Exactly. Slide 82. Foreign stocks, international stocks. Well, it used to be very difficult, almost impossible to transact for the retail investor. But that's not true anymore. It's not true anymore. Many brokerage firms offer global or sometimes called international brokerage accounts, and they allow you to buy shares on different exchanges. Now, you have to change your dollar into pesos or into euros or into yen, depending on what stock exchange the company you're interested is based. Or you can buy a company that has been moved to the United States through what are called American depository receipts. And the big global companies like Toyota and Sony and Unilever, they've all been moved to New York. And what happens? A big bank, a big trust company goes over to the UK, London or Japan, Tokyo, and on those exchanges they buy a huge amount of shares, a large, millions of shares. And then they bring them to New York and they turn around and reissue them dollar denominated. And so they're called American Depository Receipts, sometimes called GDRs, Global Depository Receipts. That makes it a whole lot easier, right? You don't have to worry about moving your dollars to a different currency. Most of us will just buy them through our mutual funds, global and international mutual funds. Remember the difference between global and international. Global meaning everyone, including the United States, or international outside, right? Now, what you have to ask yourself, although the more importantly is the worth of the company and whether the company is a good deal or not, but currency issues abound when you go off the United States shores. You have to decide what's going to happen with the dollar. In fact, some people say don't even bother. Just those fluctuations wash out over time. I don't know about that. I mean, you do have to at least take it into a consideration. What happens if the dollar gets stronger? Then any investments you have outside the United States automatically become worth less. All other things being equal, and of course they never are. It's like a seesaw. If the dollar becomes weaker, then the foreign assets are worth more. Well, if you know anybody who owns property in Mexico, you know that you can buy that property for a whole lot fewer dollars now because the peso has dropped considerably. 10 years ago it was 10 to the dollar, now it's 20. So you can go over there and buy those properties for a whole lot less. But what if you had owned the property? If you paid 10 pesos to the dollar, now if you sold the property, you're only going to get 20 pesos to the dollar. So the strong dollar has made the value of that property worth less to you. But it's an opportunity now, because now with a strong dollar, it's a great time to buy foreign assets, in my humble opinion. Because I don't think it's going to stay this strong forever. Doesn't mean I'm right. We'll see. But I think over the next 10, 15 years, the dollar will weaken because it's just gotten so strong as all the other economies start to recover more. So we've seemed to recover from the Great Recession faster than the other economies, even though it's been slow. Don't get me wrong, it's been a slow recovery, but many of the other economies are still recovering even slower than we are. So I'm pretty optimistic that the dollar is going to weaken somewhat over the next 10, 15 years. We'll come back in 10, 15 years, see if I was correct. Slide 83. Okay, let's turn so those are the major categories. And so now in worksheet number 2 and 3, we ask you to look at a stock and put it in a category, realizing that some stocks don't fit well, and sometimes stocks will fit in more than one category. Let's turn our attention now to capitalization, which is a fancy word for how much is the company worth. See, everybody tends to key on the price, the market price. But that number is meaningless unless you know how many shares are outstanding. And it's a very simple calculation that we are going to do, but you don't have to, you just look it up. It's the current price of the stock times the number of shares outstanding. Okay? And so you take the price and multiply it by the shares outstanding. And that's worksheet number 3. We do a few of those. But again, you just look it up on the Infernal Net. So, now, there are three major categories. There are a couple of subcategories, and if you remember those, that's great, but you don't have to. All you have to remember is the Papa Bear, the Mama Bear, and the Baby Bear. The large cap stocks, and again, cap doesn't mean anything to do with a baseball cap. It has to do with, it's just an abbreviation for capitalization. Large cap stocks, and we talked about this back in chapter 4 with mutual funds, right? Before we understood what capitalization meant, are stocks that are worth 10 billion or more. Well, now people are starting to say, 12 to 15 billion because of inflation. Whatever, 10 billion. Just for our purposes, we'll use 10 billion. And these are many of these companies, a lot of them you don't, but these are the big companies. Once you reach 100 billion or higher, then you move into a subcategory of large cap called mega cap. And there aren't that many companies in this category, although there are more and more of them. These are the very large companies. Mid-cap stocks, many of which you've never heard of, a few you've heard of, but these are companies anywhere between 1 or 2 billion to 10 billion. Again, some people use 1, some people use 2, some people are now using 3 or 4 billion. It's fuzzy, the categories, but let's use 2 to 10 billion dollars. The mama bears. And then small company stocks are anywhere between 1 or 2 billion or less. And many of these companies you've never heard of, and most of them will some of them will explode and become large cap stocks, but most of them won't. These are companies that may make you very, very wealthy. And people say, well, small caps do better over time. Yeah, because you're forgetting about the ones that disappear. Once you go below about 100 million, then you move into the subcategory that you don't have to remember, but I hope you do, and that's called microcap. Very speculative issues, exactly. Now, we shouldn't even discuss this in polite company, but penny stocks typically have very low valuations, much less than millions of dollars, sometimes in the hundreds of thousands of dollars. Stay away from these things. And Wall Street used to say anything below $5 a share was a penny stock, and I don't really agree with that. Sometimes it is, sometimes it's not. Again, you have to look at the number of shares outstanding. But when you see a stock that's selling for 4 cents or 0.1 cent or something like that, you just know that it's a penny stock, that it's going to be worthless someday, and you're going to be left holding the bag if you buy it. So make sure you know large, mid, small cap stock. Here's an example. $20 stock. How many shares? 5 million. So you multiply the price times the number of shares, and you wind up with 100 million. This is a small cap stock. But what we want to make sure you understand is that the stock price, for the most part, until you get to 0.1 cents or 2 cents, is irrelevant. The stock price is not important. You must look at the market capitalization to see what the value of the company is. Remember Warren Buffett's Berkshire Hathaway? Right. He refused to split the stock. So the price skyrocketed over 40, 50 years, but there are not that many shares out there. Exactly. So you'd have to look at the number of shares, or more, just look at market capitalization. And that's one of the statistics I asked you to research in your Chapter 5 assignment. And so you'll do that. This is where we would do worksheet number 3 and do the market capitalization calculations. Okay, so here's a couple of examples. Walmart versus Target. Now this is as of 9th of February. $69.08 for Walmart, $66.41 for Target. And if you just looked at the stock price, you'd think, well, Walmart and Target are basically worth about the same, aren't they? Wait a minute. Intuitively, you know that Walmart's a much bigger company, right? And you'd be right, because what we see is that Walmart has 3 billion, a little over 3 billion shares outstanding. Target has 561.5, almost 562 million. And so the market capitalization between the two is dramatic. Walmart is worth, 6 times more than Target. Yeah, Walmart is one of those mega cap stocks that's worth over $100 billion. Target's still a large company, folks. It's a $37.3 billion. It's still a big company, but it's much smaller than Walmart. Make sense? Okay, so don't just look at the stock price. Look at the market capitalization. And here's a couple other examples. AT&T and Verizon. And you see that on February 9th, it should be, that's a mistake, I have to fix that. It was $41.31 for AT&T and $48.80 for Verizon. And you might think that Verizon's bigger than AT&T, and the truth is, no, AT&T has 6.14 billion shares, Verizon is 4.08, and so they're somewhat close. They're both mega cap stocks, $253.5 billion for AT&T, and Verizon's only $199 billion. Yes, the duopoly. And by the way, they pay pretty darn good dividends, folks, so check them out. So looking at the stock price fools us into thinking that AT&T is smaller than Verizon. It turns out AT&T is bigger because we didn't look at the market capitalization. That's pretty straightforward, isn't it? Okay, you're going to do that. Slide 87. Let us finish our Chapter 5 presentations with investment strategies. We'll take a look at some investing strategies, and I'll tell you which one's my favorite. It's this one. Buy and hold. You use fundamental analysis to identify high-quality companies with good growth prospects and the potential for dividends at reasonable prices. And it goes by various names. Some people call it value investing, GARP, growth at a reasonable price. And people will say, well, how long should you hold it? Well, I love Warren Buffett's. He's a bit of a curmudgeon, and if you haven't looked up that term, remember he means he's a little ornery. How long should I hold it, Mr. Buffett? Hold it forever. Now, he's being a little facetious because you don't live forever, right? But in other words, if you bought a shoe store or a pizza shop, and it was a well-run and profitable business, you wouldn't just turn around and sell it just because the price went up 10%. You'd hold on to it. Maybe, start milking it for its cash flow and sell it in retirement or bequeath it to your grandkids or maybe your kids. So he's saying, look, don't think of it as a trading vehicle. Think of it as an asset that you're going to hang on to for the long term. And that's my favorite, right? And here's where we would take a look at the piece called Don't Lose Perspective. Because this is a wonderful piece that shows you what happens if you look on a month-to-month basis and then on a year-to-year basis. If you just try to determine what's going to happen next month, folks, you're going to drive yourself insane. It's not going to happen. You're not going to do it. I don't know anybody who can. And if they can, they're not going to tell you unless they really can't, and they're trying to convince you they can, and they want to sell you their $3,000 two-day seminar on how to do it, even though they don't know how to do it. So be a buy and hold investor, okay? All right, well, now I'll show you the others. The income strategy. Well, this is very similar to buy and hold. It's also called equity income. You emphasize dividends over capital appreciation. Ideally, you're looking for the growth of dividends. And we've noted beforehand that companies that pay consistently growing dividends, like Procter & Gamble, General Electric, Altria, Philip Morris cigarettes, tend to do well when the market as a whole does poorly. They tend to be more defensive. In general, these are appropriate for conservative stock investors. And remember the DRIPs, the dividend reinvestment plans? Oh, yes. These stocks work great for dividend reinvestment plans, because if you don't need the income, you build your wealth by dividends, buying more shares. Stocks which have had long histories of consistent dividend increases have often been the market's best long-term investments. Now, they're not going to do what a GoPro or a Tesla or an Amazon have done. They're not going to go skyrocketing, but they're also not going to go falling off a cliff. Indeed. Okay, the growth strategy. Growth stocks are the stars. Everyone wants to jump on the bandwagon as a company is experiencing strong growth. Subsequently, the stock prices bid up to very high levels, and typically they are also very risky. When the slightest hint of a slowdown in the growth appears, the stock price is often brutally punished. So these companies, we talked about the growth stocks, above average forecasts of earnings growth, we're not interested in dividends, usually have high price to earnings ratio in expectation of higher earnings in the future. Yeah, you want to have a little bit of growth, a little bit of spice, folks, but I wouldn't make it the major portion of my portfolio. You decide how you want to invest, but you want a little bit of spice, a little bit of growth, but be careful because it can burn you. Now, the aggressive growth strategy, the speculation strategy, the short-term trading, renting a stock instead of owning it. In my humble opinion, this is the strategy that many people think they're supposed to use when they start investing in stocks. It is fraught with perils and drawbacks, folks, not the least of which are the serious transaction costs that you can generate as a result of frequent trading. If you're a stockbroker with not very strong ethics, you simply adore these suckers. These speculators, traders who use this strategy. Why? Because they're going to generate a lot of income for you. The investor aggressively trades in and out of stocks in order to achieve eye-catching returns. Instead of waiting 3 to 5 years, and we're going to say why 3, 4, 5 years are a great time frame for stocks, an aggressive trader will go after the same investment in 6 months to a year or less. Some traders have time horizons in the weeks or days, but folks, you're up against the computers that are using computers, companies that are using computers, the high frequency traders who are making millions of trades per day. So I don't know if this analogy works, but you've got your little .22 caliber rifle or pistol, and you're up against people who have bazookas and tanks and aircraft with missiles. You're just outgunned. So my humble advice, don't do it. Don't even try it. Go ahead, take a little bit of money and try it, but good luck. Okay, slide number 91. Now this one is actually pretty cool, folks. Let's take a look at the contrarian strategy. It ain't easy though, that's the problem. Investing in stocks that are out of favor with the market for some reason, as reflected by the low price to earnings, remember? The value stocks and low prices compared to their fundamentals. Contrarian investors actively seek stocks from companies with sound financial statements that the market has undervalued or ignored, or they're out of favor. And here's a great quote from a long-term contrarian. I always try to be accommodating. I buy when others want to sell, and I sell when others want to buy. Yes, Benjamin Graham would be proud of this gentleman, right? But the problem with this is it's difficult, since historically the market rises about 3 times as much as it falls. So if you're always selling when everybody wants to buy, very quickly you're going to run out of stocks. It's not a steady business, is what Howard Marks, who's the CEO of Oak Tree Capital, said when asked about what it's like to be a contrarian. You have to be willing to sit on your hands when everybody else is partying and everybody on TV is talking about how great they did with GoPro and all the other growth stocks. And you have to be willing to wait until there's blood in the streets. You have to be willing to wait until things are really bad, and then you swoop in. And you wait until people are euphoric, and that's when you sell. And there's no better example of this than Mr. Buffett, Warren Buffett. We keep referring to him, but there's a good reason why. He's one of the best. In 2008, at the end of 2008, we had the Great Recession, and the housing bubble burst, and the bonds that were tied to the mortgages that were tied to the housing they were just cratering. Nobody wanted to buy them. Nobody wanted to sell them because they didn't know what the price was going to be when they tried to buy them, and nobody wanted to buy them because they thought the price would just be worthless. And the stock market responded accordingly and just fell like a stone. Mr. Buffett wrote an op-ed piece in the New York Times saying, I am buying America. I am not going to buy into this doom and gloom. We will recover. We've been through this before. We've had a heart attack. We're a top-notch athlete, but we've had a heart attack, and we will recover. And he put his money where his mouth was. He bought $5 billion worth of GE, $5 billion worth of Goldman Sachs, and then subsequently, about a year later, bought $10 billion worth of Bank of America. Yes. Now, you and I, we just don't have that kind of cash to implement, to put to work. But I personally, I basically kept putting the same amount of money in every month through dollar cost averaging. I took a little bit of money and put it into the market about 3 weeks too soon. I should have waited just about 3 weeks later, but it's done well. It's done very well. And so follow Mr. Buffett. When he's selling, you sell. When he's buying, you buy. But you and I are probably going to just buy $50, $100 a month through our mutual funds and then have a little bit of money on the side to put into stocks. But you decide. Yes, contrarian strategy is very cool. Now, these last three, I hope you will identify the risks inherent in each of these strategies. Sector rotations. The idea is you want to buy into sectors, aeronautics, or materials, or chemicals, or internet, or wireless, or energy, or whatever sector's hot, and sell the stocks in the stale ones. And many people use the sector funds that we discussed in Chapter 4 to do this. You're going to probably buy when the sector's hot, only to have it turn cold after you buy. And the one that you sold, the stale sector, that's the one that gets hot after you sell it to buy the hot sector. Momentum investing. This often goes with the aggressive growth. You buy stocks as they go up, you sell stocks as they go down, often involving selling short as they go down. You're using the greater fool theory. What? The greater fool theory? You buy high and sell higher. Because somewhere out there's a greater fool than I am. And folks, it's like musical chairs. As long as the music's playing, great. But as soon as the music stops playing, you better be sitting in a seat somewhere. This is what people did in the real estate world in the 2000s. They didn't care how high a price of a house went. They just knew some greater fool was going to come along and buy it from me until the music stopped playing, and then they went through foreclosure and vowed never to invest again until the next time. And then market timing. Don't try to buy at the bottom and sell at the top. It can't be done except by liars, says Bernard Baruch, a very famous and successful investor of the mid-20th century. Yeah, there are people who tell you that they can predict the future direction of the market. And they're lying. They may be lying intentionally. More often than not, I think they're lying to themselves. They're fooling themselves, but often they're trying to fool you. They know they can't do it. Remember the scam from Chapter 1 where he's telling you he took $33,000 and turned it into $7 million? It's ridiculous. Maybe he did it by backdating everything and said, look, if I had put $33,000 and used my system, I would have made $7 million. But no. So anybody tells you to market timers, just shake their hand and say good luck and stay away from them. So, which strategy do you favor? Of course, I've already tipped your hand and told you that you should do buy and hold. But you decide. You decide, dear students, because it's your money. I wish you the best of success. Now, we're done. we're done with Chapter 5 and the lecture notes for Chapter 5. Now, you got to go back, dear students, and study this stuff because you need to know it. You need to know all the things we discussed in here. You need to know about dividends and what's an odd lot, what's a round lot, and what else? The different calculations that we did, and all the different the stock markets and the stock market indices and the different types of stocks. We want you to know this because you are now the investment guru for your friends and family and coworkers, and you can't let them down. It is a very weighty responsibility. Cool. And now, oh boy, in our next chapter, folks, we are going to enter the temple of stock valuations. We're going to be given the secrets. Well, they're not really secrets, folks, and they're not going to help you as much as many people think they might help you. But I hope that you will see that they will tilt the odds in your favor, such that over the long term, you'll be a successful investor and you will build wealth. I think so. See you in our next chapter, Common Stock Valuations. Study hard, bring honor and glory to Southwestern Community College. We want you to be awesome. See ya!